Hi everyone, my name is Robin Speziale and I'm the national best-selling author of Market Masters. You can pick up my book at your favorite bookstore or online at amazon.com or amazon.ca. So in this video, I'll be talking about my portfolio update for the second quarter of 2017. So that would be January through June. My portfolio, for that period, year to date, from January through June, was up 13.5%. So that performance, 13.5%, beat the averages. So the Dow Jones is only up 8.67%, S&P 500 8.49%, and the TSX, it was down 0.67%. As many of you know, my portfolio is primarily invested in Canadian and U.S. stocks, based on my investment strategy, which is small and mid-cap capital compounders, mispriced large caps, and speculative takeovers. I have one of the videos on YouTube here in my channel. It's called How I Pick Winners, and you can learn more about my stock picking strategy there. So my top 10 performers in the second quarter of 2017, they're going to be posted in the description to this video. As I stated in my first quarter 2017 portfolio update, which you can find on my site, and I have a video too here. I invested more capital into some of those top performers. As you know, I trimmed my losers and I added more money to my winners. I also initiated new positions at the beginning of second quarter. So Shopify, Winpak, Pollard Banknote, Pinetree Capital, and Boyd Group. So my top 10 performers in the second quarter. So the second quarter, again, just to recap, that's the quarter ending June. So that would be Yum China, it was up 45%. Nintendo was up 44%. TECSYS was up 39%. ALIBABA was up 30%. Sleep Country was up 27%. Pinetree Capital was up 24%. Shopify was up 24%. Pacific Insight Electronics was up 18%. McDonald's was up 18%. Yum Brands was up 15%. Now, Nintendo is a great example of one of my mispriced large cap holdings. Again, Nintendo in my second quarter was up 44%. Okay, so Nintendo has always been a video gaming powerhouse. I'm still a big fan, and I'm almost 30 years old. But its stock lost 80% of its value from 2007 to 2015. The Nintendo Wii was a big hit, but then Nintendo seemed to just dwindle from there. It started to look like Nintendo could share the same fate as Sega. But then in 2015, Nintendo's management made several key announcements with plans to unlock their intellectual property. The Nintendo theme park, Universal Resorts, mobile games in partnership with DNA, and talks of movies, virtual reality, etc. This was big news in 2015 because Nintendo has always been apprehensive to venture into new markets. That's why I initiated my position in Nintendo stock in 2015. They've got a treasure chest of valuable IP, which I would compare to Disney's. Let's see it continue to go to work. I'm up 100% on Nintendo since 2015, by the way. You can read more about Nintendo's intellectual property plans. Just go to Google and you can learn more. You can see my full watch list and portfolio in my new book, Capital Compounders. Email me. It's in the description to my video. Find my email address. Email me. Request a free copy. I'll send you Capital Compounders. But also note that I've added more stocks to my watch list. Brookfield Infrastructure Partners, Fairfax India, Waste Connections, Mogul Financial, and Jameson Wellness. They're on my watch list, in Q2. One of my biggest losers in the second quarter of 2017 was Canopy Growth, which has a ticker symbol WEED, W-E-E-D, how appropriate. It's a marijuana producing company. It was down 25% in the second quarter, but I'm still long the stock. I started buying shares in WEED at $1 per share when it was trading on the venture exchange. There's still a very significant wealth transfer from, I love to say this, from drug dealers to licensed producers and sellers happening in Canada that I compare to the Blockbuster and Netflix wealth transfer. Isn't capitalism just great? Overall, I'm happy with my performance so far this year, but the tide could turn. In Canada, overnight rates may rise. Again, I wrote this, a couple months ago. They did rise for the first time in 7 years, which could be worrisome given our high consumer mortgage debt load, which is true $2 trillion, combined with a lofty housing market, which I wrote about and have a video about called "The Truth Is Out There." I'm not terribly concerned though, as my portfolio is not exposed to the financial sector. Most of my holdings are in technology, consumer, and diversified industries. If I'm up 15% for the year, excluding dividends, that'll be good for me. But even if the market comes down, I'll just buy some stocks on sale, as I've done before in other corrections, crashes, and bear markets. I'm building wealth for the long term. All right, guys, thanks for listening, and talk soon.